Most traders see this rally and they're already hitting the buy button. That is exactly what the market wants. Right now, pound sterling to US dollar is running higher into a wall of structural supply that has defined the monthly and weekly trend. We are in a strong sell on the higher timeframes, and yet the intraday charts are flashing strong buy. This is not a contradiction. It's a trap. There is one danger zone and one hidden opportunity right now. I'll show you both. The number you need to tattoo on your brain is 1.3285. That level is the daily 20-period moving average, and it is the whole game. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today. Damn, why session bias is. Fade the intraday strength into resistance. This is a counter-trend rally within a firmly bearish market structure. The monthly trend is sell. The weekly trend is strong sell. The daily trend is strong sell. That is the tide. What we are seeing on the 5-hour and 1-hour charts is a short covering wave driven by dollar weakness, not genuine sterling strength. I'm treating this as a mean reversion opportunity. The single invalidation level that flips my entire bias is a daily close above the 50-period moving average at 1.3359. If we close above that, the structure resets. But until then, I am selling rallies. Write this number down, 1.3359. If we break and hold above that today, the whole medium-term bearish thesis is on ice. Now, where is the herd? The herd is long right now because they see a strong short-term trend and they're chasing the momentum. The sentiment is leaning bullish, and that means the stops are building below. When this rally fails, the liquidation will be violent. That's our edge. Let's walk the chart from the top down, so you understand the battlefield. On the weekly chart, we are below the 20-week moving average, the 60-week, and the 200-week. Price has been in a descending channel since the rejection near 1.343 weeks ago. That weekly candle was a massive bearish engulfing. The weekly MACD is still printing lower bars, signal line accelerating south. There is no bullish divergence on the weekly. This is a trend continuation structure. Drop down to the daily. Price is currently at 1.3260. We are trading below the MA20 at 1.3285, below the MA50 at 1.3359, below the MA100 at 1.3389, and below the MA200 at 1.3369. That is a textbook bearish alignment. Every single major moving average is sloping lower. The RSI on the daily is 44.67, nowhere near oversold, so there's room to fall. The MACD on the daily is still negative at minus 0.007, but the histogram bars are ticking slightly higher. This is where it gets interesting. We are seeing a subtle loss of downside momentum, but no confirmed bullish cross. It's a bear flag, not a reversal. Now, here's what most traders miss. The 4-hour chart is showing a bullish MACD cross, and the 60-minute chart is in strong buy territory with price above the 5 and 10 MAs. But this intraday strength is happening on declining ATR. The average true range is just 0.0077. That tells me this is a low volatility grind higher, the kind that traps breakout chasers. The ADX on the daily is 28.24, confirming a strong trend, but the CCI is at minus 30, not yet overbought. So we've got room to rally a bit more before the sellers step in. Key support and resistance levels are critical. The pivot point for today is 1.3201. We've already smashed through a 1 at 1.3211, a 2 at 1.3224, and a 3 at 1.3234. Price is now well above a 3 at 1.3260. That means the intraday breakout is extended. Support levels to watch on any pullback: S1 at 1.3188, S2 at 1.3178, S3 at 1.3165. That support cluster between 1.3165 and 1.3188 is the floor. If we lose that, the sell-off accelerates towards 1.31. Resistance above is 1.3285, then the psychological 1.3300, then the 50 MA at 1.3359. Here's another insight for the silent viewers. The 5-minute and 15-minute charts are showing negative divergence on the RSI against this recent price push. The price is making higher highs, but the RSI is not. That's the hidden signal that smart money is already fading into this rally. It's not visible on the higher timeframes yet, but the divergence is building. This is exactly the kind of setup I look for when I want to sell into strength. Retention bridge at 3 o'clock. Here's what most traders miss. The dollar weakness today is being driven by a temporary dip in US yields, but the UK-US 10-year yield spread is still widening in favor of the dollar. The bond market hasn't confirmed this cable rally. That's a major red flag. The 24-hour news window gives us a clear catalyst. Sterling is gaining because of persistent dollar weakness, but this is not a sterling story. The dollar index is under pressure ahead of some softer US housing data, and the market is pricing a lower probability of a hawkish Fed surprise. Meanwhile, investors are waiting for a closely watched speech from Andy Burnham. Now, Burnham isn't a Bank of England official, but his political influence in the UK can shift fiscal sentiment, especially around infrastructure spending and regional economic growth. If his comments signal expansionary fiscal policy, that could give sterling a short-term pop. But let's be clear, the Bank of England is still dovish relative to the Federation. The policy divergence is alive and well. UK services inflation is stickier, but the growth outlook is dismal. That's why the weekly chart is screaming sell. Cross-linkage matters. Look at euro to US dollar. It's also rallying, but both pairs are struggling at their respective daily MAs. This is a coordinated dollar weakness move, not a sterling breakout. If the dollar index breaks 105 to the upside this week, all of these cable gains evaporate. I want you to comment right now. Do you think the dollar breaks 105 this week? Comment yes or no. I'm tracking consensus, and I'll call out the winning bias in tomorrow's video. The 1 to 2 week directional lean for pound sterling to US dollar remains bearish. I expect a rejection at 1.3285 or 1.3300, followed by a retest of 1.3200 and then 1.3100. The invalidation for this view is a daily close above 1.3359, as I said. If that happens, we could see a squeeze toward 1.3500, but I give that a low probability. Most people skip this section. That's exactly where the money is made. Keep watching. I'm about to lay out 2 scalping strategies and 1 swing trade that align with the higher timeframe structure and the intraday noise. Strategy 1, the opening scalp, scalping, high probability. We are going to exploit the intraday momentum exhaustion right at the daily 20 MA. Here's the exact play. Wait for price to tap 1.3285 on the 5-minute chart. We need a strong rejection, a bearish engulfing candle, or a shooting star with a long upper wick, printed exactly at that level. The entry is at the close of that 5-minute rejection candle, roughly around 1.3280 to 1.3285. Your stop loss goes at 1.3295, just 10 pips above the high of the spike. That's a tight stop, but scalp risk must be contained. Take profit 1 is at 1.3260. That's the current price area, a 25 pip scalp with a risk reward of about 1:2. If momentum accelerates, you can hold a runner to take profit 2 at 1.3240, targeting the older 3 level now acting as support. This scalp is instantly voided if the 5-minute candle closes above 1.3290 with no rejection. That would signal real buying pressure, and we do not fight that the opening SCLP entry, 1.3280 to 1.3285, 5M bearish engulfing a shooting star at 1.3285 tap, stop loss, 1.3295 take profit 1, 1.3260 take profit 2, optional 1.3240 risk, and reward, approx 1:2.0 R invalidation, void if 5M candle closes above 1.3290 without rejection. Strategy 2, the liquidity grab, scalping, counter noise. This is a classic stop on play. All those late longs who bought the breakout above a 3 near 1.3234 are sitting with stops just below that level. The market loves to revisit those liquidity pools. I want you to wait for a quick drop, a fake breakdown, below 1.3234. On the 15-minute chart, we need a wick below 1.3230 that immediately snaps back and closes the 15-minute candle above 1.3234. That is the bear trap. You enter long at the close of that candle, around 1.3235 to 1.3240. Stop loss goes at 1.3220, below the wick and below the pivot. Target is a fast scalp back to 1.3260, the current area. That's a 20 to 25 pip grab with a 15 to 20 pip stop. Risk reward isn't huge, but the probability is very high because you're trading against the stops. This setup requires fast execution. If the 15-minute candle closes below 1.3230 without snapping back, you stay flat. No heroics. The liquidity GBP entry, 1.3235 to 1.3240, 15M snapback close above 1.3234 after a wick below 1.3230, stop loss, 1.3220 take profit 1.3260 risk, reward. Approx 1:1.3, 1.5 are invalidation. Void if 15M close below 1.3230 without immediate recovery. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. My traders know I love a good liquidity grab. When the herd is leaning one way, strategy 3, the session swing, trend alignment, this is the big one. The swing trade aligns with the daily and weekly bearish trend. We wait for the intraday rally to fail at 1.3285. For confirmation, we need the 4-hour candle to close below the 1.3260 level. That's below the 5-period MA on the 4-hour and signals the intraday momentum has broken. Entry is on the close of that 4-hour candle, at market, around 1.3255 to 1.3260. Stop loss is placed above the daily structure at 1.3310, giving the trade room to breathe but staying above the psychological 1.33 and the MA20. Take profit 1 is at 1.3188, the S1 support, which aligns with the pivot area. That's about 60 pips. Take profit 2 is stretched at 1.3100, the round number where the weekly structure shows prior consolidation. Risk reward on this swing is roughly 1 minute and 1.5 seconds to TP1, and 1 minute and 3.5 seconds to TP2. Once price reaches halfway to TP1, at 1.3225, move your stop to break even. The invalidation that would shift the medium-term outlook is a daily close above 1.3359. If that happens, this swing trade is dead, and you flip to neutral the session SRNG entry, 1.3255 to 1.3260, for H close below 1.3260 after rally failure at 1.3285, stop loss, 1.3310 take profit 1.3188 take profit 2, 1.3100 risk, reward, 1:1.5R to TP1, 1:3.5R to TP2 invalidation. Void if daily close above 1.3359. Never risk more than 1 to 2% per trade. For scalps, I keep it under 0.5%. No positions through high-impact news. Today. That means Andy Burnham's speech could spike volatility. Know the time of that event and either flatten or tighten stops. Stops are non-negotiable. This is how you survive to trade the next big move. The pound can gap. We've seen it. Protect your capital first. The single most critical level for the next session is 1.3285. That is the bull trap ceiling. If price closes above it on the 4-hour, the intraday narrative shifts to neutral, and we step aside. But if we reject, and I believe we will, the swing short targets 1.3188 and then 1.3100. Tomorrow, I'll be watching the fallout from Burnham's comments and the US durable goods data. If 1.3200 breaks, the whole monthly trend accelerates. I'll have the updated blueprint 24 hours from now. You do not want to miss that. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Tap the end screen. It's a monster session for risk assets, and the liquidity tide is shifting. Then hit the bell so tomorrow's alert lands before the London Open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter. We are building a community of disciplined traders who scalp the noise and swing the trend.